Hey guys, how's it going? Brian Burns here with the Master Key Group at RE/MAX Downtown, and welcome to episode 3. And we're talking about the fundamentals of investing in real estate. Now, if you have not seen episode 2 yet, stop right now, go back and check out episode 2. That is where I really laid the foundation for a lot of the metrics that what we're going to be using today. Okay, so those, and what we're doing is we are locating and identifying investment opportunities, okay? And we use those metrics to decide that. Now, this is an example property, and this was from last week as well. This is property A, okay? Now, property A, we've purchased it at $165. We have put a down payment of 20% at $33,000. The closing costs were about $5,000, and then repairs, which means what it costs us as far as like updates or anything like that, new appliances, to put ourselves in business, okay? So that goes to our total cash in. That's $43,000. Then we go to our carrying costs, okay? So we've started the business. How much does it cost us to run the business, okay, on an annual basis? So our carrying costs, your annual carrying costs includes your principal and interest, right? Because you have to pay that, all right? Now, operating expenses, when someone is looking from the outside in, they want to know operating expenses. They don't care what your mortgage is, because they may have completely different mortgage terms. They may be paying cash. So that is for them to decide, not for you, okay? And when you're looking at an opportunity, you need to see what your principal and interest is gonna look like, okay? So the operating expenses is for someone outside looking in. Annual carrying costs is for you, because you can plug in your scenario with principal and interest if you have it, okay? So the year one is what we're gonna be working with. So your total annual operating expenses is going to be $10,500. All right. Now the other thing we're adding in here is our miscellaneous costs, because you have to assume at some point that A, that it'll be vacant, and that B, that something is going to break, right? So 5% of your gross income is a way to account for that. Now, if you take the 12 months of the year and you take a percentage of that, generally a month is 8.5% of a year, okay? So 5% accounts for you having a vacancy once every 2 years. Maybe you have the dream tenant and they stay there for 5, 6, even 7 years, but then say they move out and you have to make some repairs, or it just takes you a little bit to rent it out and you are vacant for 2 months. Well, guess what? If you take the average of that, that still puts you at 5% vacancy, okay? So it's always good to account for that kind of stuff. And then maintenance and repair. So this is just general upkeep, okay? So we've started the business, we're running the business, something may happen along the way and you have to account for that, because the last thing you want to do is shut down your business because you can't make a basic repair, all right? So what we've done here is 2% of the property value on an annual basis. Now, will $3,000 worth of stuff break every year? No. What you're going to do is you're kind of keeping an escrow account. And so for a $165,000 property, maybe you keep a $10,000 escrow account. Once it hits $10,000, you don't have to keep putting into it, but once it goes below that, then you would start to contribute back to it, okay? Now, if you had, say, a $1 million property, $10,000 is not a good escrow amount, because the stove range might cost $10,000. So you have to kind of make it appropriate to the property. Now, you may buy new construction. New construction is not going to have very many repairs along the way for the first 5 to 7 years, but you still want to keep that escrow account, okay? So it's very specific based on the type of property. Now, my favorite part, we break out the green marker because we're making money now, right? We're in business. We've seen how much it costs to run our business. And now let's see. So this one I told you is a duplex, and that's why we've accounted for, on this side, we've accounted for utilities. It's usually you're not paying the utilities to your property, but the way this one is set up specifically, because this is an actual real property, there is a $300 monthly utility cap that you're giving to the tenants. So the main unit rents for $1,600 a month. The lockout rents out for $900 a month. Now, this, if you were trying to see like what kind of income you're doing on a monthly basis budget-wise, yes, this monthly one is the good one to look at, but we're doing an annual basis, which is obviously more important, right? Because we need to find what, because we're looking at this investment from the outside in. So we need to see how much money this is making us. So we have a net income, or sorry, a gross income of $30,000. Now, let's take that money, or let's take that, that dollar amount and see what actually goes into our pocket, right? Because that's the important part. Now, here's our metrics. We have our net operating income. If we remember, that is our gross income. This number here and then our operating expenses. So we're just going to take this number, slide it down into here, and then our operating expenses, we talked about it over there, $10,500. We get $19,500. Now, if you had paid cash for the property, this would be the amount of money that you take home. But we have a mortgage, right? So we have to pay the mortgage. Now, a cap rate is going to be a percentage, and this is our net operating income divided by the purchase price. This is a great number for finding out the future value of the property, okay? So we have our net operating income, and then we have the purchase price. That means that we have 11.8% cap rate. That is very good. Generally, investors are looking from 5 to 8% cap rate. So what does that mean? That means that this property has a lot of value to increase for you to be able to sell it again. So now the net operating income should remain more or less the same. The taxes will fluctuate a little bit, but mostly the net operating income should remain the same. So the only thing that can make this percentage go down is for the purchase price to go up, which means that people will continue to buy at a higher price until this percentage gets between 8 to 5%. Okay, so let's take a make-believe number. Say the house was to sell for $200,000. Even at $200,000, with these numbers the same, and statistically rent would actually probably go up, but with these same numbers, selling at $200,000 still gets you a 9.75% cap rate, which means that this property has room to grow big time. Okay, $35,000 just to get to under 10%. All right. Now, this one is great for investors who are going to take out a mortgage. So cash on cash return. So here's what we do. We take our before tax cash flow. All right. So we take all of our expenses. All right, and then so our annual carrying costs, our vacancy, and our maintenance, we subtract all of those from our gross income. That is our before tax cash flow. So that means that our absolute take home bottom line raw number is $5,280. All right. Now we take that, and when we bought this property, we didn't pay $165 for it. Remember, we paid $43,000 to get this property started. All of these other expenses don't matter because they're getting paid for by your tenant, and we've already subtracted them from that number. All right. So we have put in $43,000. We're making $5,200 and change a year. So that means that we have a cash on cash return of 12.27%. Now this is important because it'll show you in just 8.14 years, you'll have doubled the money that you put in. The big thing about it is that this $43,000 is not gone. It's still there. So when you sell the property, you'll recoup that money. Not only that, but so in 8 years, you'll have recovered the amount of money that you put in just through doing business, just through rental income. We've already established here that this property has room to grow, and we haven't even gone over when you sell the property, what your actual return on investment is, because that's one of our vocab words was return on investment. That's a very vague number because you can use it to kind of establish what's your annual return on investment, what was your total return on investment from owning the property. So we're not going to go over that specifically today, but yeah, so this is a lot of information. Feel free to go back over it. But yeah, this really breaks down into hard numbers what this property does and how it performs. And then next week, what we're going to go over is about 95% of everybody's first investment, and that's going to be their primary residence. Look forward to seeing you there. Bye.